Hello and welcome to the fourth video for Chapter 3 in Accounting 205. Today we're going to talk about several things and not spend too much time on each one. I want to start on page 316 and talk about meals and entertainment, and then we will also talk about educational expense, dues and subscription, clothing, gifts, and bad debts in this video. Okay, on meals and entertainment, generally what you would do there is you simply would deduct about 50%, okay, of the cost of whatever the meal or the entertainment is. Okay, this would include both you and anybody that accompanied you, as long as it's for a business purpose. Okay, so, if you and your spouse, for example, took a client to lunch and your spouse was not related to your company, then you could deduct 50% of your meal, 50% of your client's meal, but not your spouse's. All right, if your spouse works for the company, then you should be able to deduct 50% of his or her meal also. Okay, one thing to note at the bottom of page 316 is that dues to golf clubs, like Knollwood Country Club or Morris Park Country Club or something like that, the annual dues to these clubs are not deductible. All right, even though a lot of business is done there, those kind of dues are not deductible because it's thought of that it's mainly designed for pleasure and not for business. However, if you take your client to the golf course and you pay his or her green fees, the cost of playing a round of golf, that is deductible. All right. Also, if you have any dues to a charitable type organization like the Kiwanis or the Lions Club or something like that, clubs that mainly do charity and civic work, okay, you could deduct those expenses as ordinary business expenses. You would not deduct them as charitable contributions. Okay, keep in mind that right now we're talking about a Schedule C, a sole proprietor, and remember, sole proprietors can't make charitable contributions and deduct it on Schedule C. They would have to deduct it on Schedule A as a personal charitable deduction, and we'll talk about that in Chapter 5. Okay, educational expenses. The important part here is to look at page 317 and note the two items listed there kind of 2/3 of the way down the page. It says the educational expenses must be paid to meet the requirements of the taxpayer's employer or the requirements of law to keep their job. All right, to keep their job. There's nothing wrong with improving your status at the company if the boss says, we need you, for example, to go to Ivy Tech and take an Excel course, and they don't pay for it, all right, you can deduct that, all right, but, if your boss said, it'd be great if you had a bachelor's degree, but it isn't required for the job, and you decide to go get a bachelor's degree, okay, you cannot write that off as an educational expense. You might be able to take a credit for it on the back of the return, but it is not an educational expense. Okay, and again, the educational expenses must be paid to maintain or prove existing skills required for your present work. All right, so that's very important. In many places, the business will pay for your education because obviously they want to keep you, all right, for the most part, and they're willing to make an investment in you. Okay, all right. If you are an educator, all right, in other words, you teach kindergarten through grade 12, all right, Congress still passed the educator expense rule. All right, that is line 23 of Form 1040, and those are still deductible up to $250 a year. All right, unfortunately, college teachers cannot take that kind of a deduction. Only K through 12 teachers can take it. All right, on page 320, all right, they talk about dues and subscriptions. All right, generally, again, you know, anything like that would be deductible as long as related to your job. Okay, so, you know, if you're a tax accountant and you subscribe to Sports Illustrated, okay, that would not be an ordinary deduction on Schedule C, unless, of course, you are maintaining an office and you have a waiting room and you want people to read, you know, magazines while they're sitting out there waiting for you. That's a little bit different. All right, subscriptions to trade journals, things like that will always be deductible, because the idea there is that it improves your knowledge, increases your revenue, and therefore when your revenues go up, your expenses are allowed to go up with it. All right, special clothing and uniforms on page 320. I've used this rule for years, and I call it the Church on Sunday rule. All right, if you could wear it or would normally wear it to church on Sunday, it generally is not deductible. All right, for example, I've had a lot of truck driver clients, and they're like, well, Rob, can I write off my blue jeans? And I'm like, no. And they're like, well, I need them for my job. I says, you also need them just to wear anyways, you know. But on the other hand, if I have a contractor come to me and say, you know, Rob, I went to the working person's store in Lakeville, or I bought, you know, a special set of Dickies outerwear, you know, you wouldn't wear that to church on Sunday. All right, so therefore it would normally be deductible. So things like uniforms, you know, nurses, you know, they spend a lot of money on their scrubs and their uniforms. Anything you're required, like safety glasses, even a watch, you know, if you're required to wear a watch like a nurse does when they have to take blood pressures, that would be deductible as long as it's required by your employer. Business gifts. The first paragraph under business gifts, you're probably going to want to highlight for the quiz or the test. All right, you can donate up to $25 a year, or gift, I should say, up to $25 per year per donee. All right, if your wife also donates, all right, you know, I should say you're donating to a client and his spouse, it also must be no more than $25 a year. De minimis gifts, you know, for example, you give out pens with your name on it. There is no limit to that because of the small amount of the gift. Okay. Lastly, for this section, all right, on page 322, there is a discussion of bad debts. All right. This gets a little critical. All right. So, for example, let's say, you know, you sold your car to a friend, you know, for $3,000, and the friend never paid you back. All right, if you've got a written agreement and you got a bill of sale, you can write that off, but that becomes a capital loss, and you would have to deduct that as a capital loss. Okay, that is a non-business bad debt. If you have a business bad debt, okay, this will depend upon whether or not you're using the cash method of accounting or the accrual method of accounting. All right, okay, you're not required to understand that for Accounting 205, so I'll just mention it quickly. If you're using the accrual method of accounting, that means you've already recorded the sale, and therefore if you have a bad debt, you can write it off against that sale. If you're using the cash method of accounting, you should not have recorded the sale unless you received the money. So therefore you cannot record a business bad debt if you didn't already record the revenue to begin with. All right, again, that's under the cash method of accounting. All right, that ends this video, and in our last video for chapter 3 we will discuss office in the home.